It doesn't make sense. If you're trading off the textbook, if you're looking at the correlation models that have dictated the last 20 years of precious metals movement, what happened on Tuesday morning should not have happened. It wasn't just a deviation, it was a violation of the rules. Look at the 10-year. You have the yield spiking, punching through 4.3%. You have a Fed nomination that the market is reading as aggressively hawkish. Kevin Warsh is not a guy who prints money for fun. The dollar index reacts exactly how you'd expect. It rips. By every standard metric, by every algorithm running in New York and London, silver should be dead in the water right now. It should be retesting the lows of the cycle. When real yields jump, and they did jump, non-yielding assets are supposed to be liquidated. That is the trade. That is the mechanical function of the market. And for about 3 hours, that's exactly what it looked like was happening. We saw the flush. We saw the paper price collapse down to $79. It looked like a standard liquidity event, the kind where margin clerks just hit sell on everything to cover the bond losses. But then it stopped. It didn't just stabilize, it violently reversed. We aren't talking about a dead cat bounce here. We are talking about silver reclaiming 12% in a single session, pushing back over $86 right in the face of a rising 10-year. That divergence is the most dangerous signal I have seen in months. When an asset stops reacting to its primary bearish driver, you have to stop and ask what is actually moving the price, because it's not the dollar anymore, and it's not the Fed funds rate. If higher weights can't kill the price, then the sellers are exhausted. Most people are looking at that chart and seeing a buy signal. I'm looking at it and seeing a broken mechanism. This is where traps form. You have a market that is pricing in a credit event while simultaneously pricing in a hawkish Fed. And those two realities cannot coexist for long. One of them is a lie. I want you to look closely at the volume profile during that reversal. It wasn't speculative frenzy, it was desperate accumulation. Someone or some entity used that dip not to exit, but to absorb. They stepped in front of a freight train of selling pressure, driven by the Warsh news, driven by the margin hikes, and they bought it all. We need to talk about why silver refused to break when the macro environment screamed that it should. Because this isn't about inflation anymore, it's about collateral. And if you don't understand the difference between the paper price crashing and the physical market snapping back, you are going to misread the next 48 hours completely. See, the hardest part of trading these events isn't the initial move. The initial move is usually just noise. It's algorithmic. The machines see Warsh nominated. They scrape the headlines for hawk. They look at the 10-year yield spiking to 4.3, and the logic gate opens. Sell gold, sell silver, buy dollars. It happens in milliseconds. That's the flush we saw down to $79. That wasn't a human decision. That was code executing a correlation trade that has worked for 40 years. But here's where you have to be careful. Here's where the retail investor gets chewed up. Because while the algorithms were dumping paper contracts, the physical market did something completely different. It didn't blink. In fact, if you look at the premium data coming out of the Asian hubs during that sell-off, premiums actually ticked up. Think about that contradiction. The global price is crashing, theoretically making the metal cheaper, but the cost to actually get your hands on a bar is rising. That is the first crack in the narrative. When the CME raised margin requirements, and we knew that was coming, didn't we? We saw the notices. 15% here, 36% there, depending on your broker. That is a forced liquidation event. It has nothing to do with the value of silver. It has to do with leverage. It forces the weak hands, the guys who are overextended on futures contracts, to puke their positions. And usually that creates a cascade. The selling begets more selling, stops get triggered, and the price falls into a vacuum. Except this time, there was no vacuum. At $79, the selling just stopped. It hit a wall, and that wall was real demand, not speculative demand, industrial demand, sovereign demand, the kind of buyers who don't care about a 25 basis point hike in the 10-year yield because they are looking at a structural deficit in the metal itself. They saw $79 and they didn't see a chart breakdown, they saw a discount. And this brings me to the number that nobody is talking about. Everyone is obsessed with the price, but look at the open interest relative to the volume on the rebound. We had a 12% move up from the lows back over 86 on declining open interest in the later hours. Do you know what that means? It means short covering. It means the people who sold the breakdown, the people who bet on the Warsh news crushing the market, they got trapped. They tried to press to short, they realized there was no more inventory to sell, and they had to scramble to buy back their own contracts at higher prices to get out alive. That is a classic bear trap, and it's forming right now in real time. This is the part that usually gets people into trouble. You see the rebound, you see the squeeze, and you think, okay, the coast is clear, the bottom is in. But you have to understand who is trapped here. It's not just the retail shorts, it's the institutional desks that use silver as a proxy for rates. They are currently sitting on massive underwater positions because they trusted the correlation. They trusted that higher yields meant lower silver, and the market just told them they were wrong. When a correlation breaks, it doesn't just snap back, it creates volatility, violent volatility, because now every time yields tick up, those algorithms are going to try to sell silver again, and every time they do, if the physical buyers step in like they did today, the floor gets higher. You are watching a war between a mathematical model and a physical reality. The model says silver should be $60 right now, with rates where they are. The reality says you can't get it for less than 86. And let's be honest about the 10-year yield for a second. 4.3%. That is the line in the sand. That is the level where things start to break in the broader economy. Housing, auto loans, commercial real estate refinancing, it all chokes at this level. The bond market knows this. The bond market is testing the Fed. It's daring them to keep rates high. And silver is sniffing out the pivot before the pivot happens. It's pricing in the fact that the Fed cannot sustain this hawkish stance without breaking something critical. So when you see that price rip 12% in a day, don't look at it as a victory lap. Look at it as a warning. The volatility is expanding because the system is trying to find a new equilibrium and it can't find it. The price discovery mechanism is fractured. I want to point out one more data point from the Tuesday session that most people missed. Look at the timestamp of the reversal. It didn't happen during the US Open. It happened before. It started in London and accelerated as New York came online. That tells me the smart money was positioning ahead of the liquidity. They knew the margin calls were finishing up. They waited for the flush to clear the deck and then they stepped in. But here's the danger. If you're sitting there thinking this is a straight shot to triple digits, you're ignoring the mechanics of the futures market. The commercial shorts, the big banks who are usually on the other side of this trade, they aren't stupid. They have deeper pockets than the squeeze crowd, and they have one weapon left. They can't dump physical metal they don't have, but they can still layer paper supply to cap the rallies. We saw it a bit near the close, right at the 87 level, a massive block of sell orders just sitting there, absorbing the momentum. They're trying to paint a chart that looks like a dead cat bounce. They want the technical traders to look at today's candle and say, oh, it rallied too fast, it has to fill the gap. They want to induce doubt. Because if the sentiment turns bullish again, if people start believing the refuse to break narrative, then the shorts are in serious trouble. They need you to believe this was a fluke. They need you to believe that the 10-year yield matters more than the physical shortage. So who's exposed right now? The momentum chasers who bought the top yesterday? No, they already got washed out. The people exposed are the ones who are shorting this rally thinking the macroeconomics still apply. They're the ones standing on the tracks. And who's protected? The people who understand that price is just a signal. And right now, the signal is jammed. I'm going to show you exactly how this mechanism works in the next segment, because if you don't understand how the authorized participants create and redeem shares of the ETFs, you won't understand why the price divergence is sustainable. We aren't just seeing a short squeeze, we are seeing a collateral shortage, and that is a very different animal. That is the kind of thing that breaks exchanges. You need to understand the plumbing. The price on your screen isn't just a number, it's a derivative of a mechanism, and that mechanism is usually invisible. It works in the background, keeping the futures price tethered to the spot price, keeping the ETFs tracking the metal. But when you get a violent move like we thought today, a 12% rip in the face of a bond market rout, it means the plumbing is leaking. Here is the mechanism that everyone is missing right now. It's not about people buying silver. It's about the authorized participants, the APs. These are the big banks, the institutions that create and redeem shares of the major silver ETFs. Usually, when the price drops, they can step in, buy the physical metal cheap, hedge it with futures, and pocket the difference. It's an arbitrage machine. It's free money for them. It keeps the market liquid. But yesterday at $79, that machine jammed. Why? Because for the arbitrage to work, you have to be able to source the physical metal at the paper price. You have to be able to call up a vault in London or a supplier in Zurich and say, I'll take 10 tons at $79. And yesterday, the answer on the other end of that phone line wasn't sure. It was no. The physical holders, the refiners, the miners who have been burned for 3 years, the sovereign wealth funds quietly stacking, they simply withdrew the inventory. They didn't sell into the crash, they pulled the offers. So the APs found themselves in a terrifying position. The paper market said the price was crashing, but the physical market had effectively gone no bid. You couldn't buy the metal to cover the paper. That is what triggered the snapback. It wasn't a wave of enthusiastic retail buying. It was a vacuum of physical sellers. The paper shorts looked down and realized there was no floor beneath them, but there was also no inventory to cover with. The only way out was up. They had to bid the price up to find liquidity. They had to pay up to 86 just to find someone willing to part with the metal. This is the definition of a supply shock. It's not that there isn't enough silver in the ground. It's that at these prices, with these yields, the existing silver is in strong hands that aren't scared of Kevin Warsh. They aren't scared of the 10-year yield. They are holding for the credit event. And this brings us to the behavioral signal that I am watching. It's subtle. You won't see it on CNBC. You have to look at the commercial hedging data. Usually, when silver rallies 12% in a day, the miners, the producers, rush to lock in prices. They sell futures aggressively to guarantee their revenue. It's standard practice. We call it capping the rally. But look at the flow today. The producer hedging was light. It was almost non-existent relative to the volume. Why? Because the miners are starting to smell blood. They are looking at their input costs, energy, labor, equipment, and they are looking at the yield curve, and they're saying, why would I sell my future production at $86 when the monetary system is flashing red? They are withholding supply. That is a massive psychological shift. When the producers stop hedging, the ceiling on the price disappears. The commercial banks lose their natural partner in the short trade. They are left naked on the short side without the miners to bail them out. Now, I need to stop here. I need to be intellectually honest with you, because it is very easy to get caught up in the silver squeeze narrative and ignore the reality of what could go wrong. I am not a permeable. I don't believe silver goes up in a straight line forever. So, what would invalidate this entire thesis? What would make me look at this chart and say, I was wrong, this is a trap? If the 10-year yield keeps climbing, if it goes to 4.5, 4.6, and we don't see something break in the banking sector immediately, then the dollar is going to act like a wrecking ball. If the market digests these higher rates and the economy keeps humming along, then silver is just an overpriced industrial commodity in a deflationary world. Specifically, I am watching the open interest. If we see the price of silver start to drift lower again, back towards 80, and the open interest rises during that sell-off, that means the shorts are reloading comfortably. It means they aren't scared. It means they found new liquidity. If I see that pattern, price down, open interest up, then this rebound was just a spasm. It was a dead cat bounce, and I will be the first to tell you to get defensive. I'm not here to marry a position. I'm here to survive the cycle. But that's not what we are seeing yet. We are seeing price resilience in the face of macro headwinds. Most people are missing the fact that silver is effectively functioning as a credit default swap right now. It's trading like insurance. When you buy insurance, you don't care if the premiums go up a little bit. You care that the house is on fire. The bond market is the fire. The volatility in the 10-year yield is the smoke, and silver is the exit door. People are looking at the nominal price. Oh, silver's 86, that's expensive. No, you have to look at silver relative to the monetary base. You have to look at it relative to the debt service cost of the US government. By those metrics, silver hasn't even started to move. The rebound today was just a market acknowledging that the price was wrong. It wasn't a rally, it was a correction to fair value. So we are left with a split reality. On one side, you have the soft landing narrative. This is the view that says the Fed can hike rates, crush inflation, and everything will be fine. If you believe that, you should be selling this silver rally. You should be shorting it with both hands. On the other side, you have the fiscal dominance reality. This is the view that the debt matters more than the rates. It says that the higher the rates go, the faster the system breaks, and the faster the Fed has to pivot. Not because they want to, but because they have to save the treasury market. This leaves us with a binary setup. We are approaching a decision point that will likely resolve in the next 48 to 72 hours. Path 1, the bond market forces the Fed's hand. The yields spike too fast. Something in the repo market or the banking sector snaps, just like we saw in March 2023, just like we saw in September 2019. If that happens, the dollar rolls over and silver doesn't just go to 100, it disconnects from the paper pricing mechanism entirely. The premiums blow out and the physical metal disappears. Path 2, the Fed calls the market's bluff. Warsh comes out and doubles down on the hawkish rhetoric. He says, "We will tolerate pain." The markets believe him. Asset prices across the board, stocks, real estate, crypto, and yes, silver, get liquidated in a dash for cash. In that scenario, $86 isn't the floor, it's the resistance. We go back to the 60s. So where does this leave us? We are staring at a market that is fundamentally broken. The price discovery mechanism, the futures market, is trying to tell us one thing, while the physical market is screaming something else. And you, as an individual, have to navigate this gap without getting crushed by the volatility that fills it. Here is the scenario tree I am working from. It's not a prediction, it's a decision matrix. First, let's look at the hard break scenario. This is what the bond market is currently pricing in. If the 10-year yield pushes past 4.3 and starts testing 4.5, the mathematics of the US debt service become impossible. We aren't talking about politics here, we are talking about arithmetic. At that level, the interest expense consumes the entire discretionary budget. The banking sector's held-to-maturity portfolios, those safe treasuries they bought 2 years ago, implode in value. If we see yields break 4.5, the Fed will have no choice. Warsh can be as hawkish as he wants, but he cannot oversee a sovereign default. He will be forced to pivot, and not a polite pivot, a panic pivot. Yield curve control, emergency liquidity, the works. In that scenario, silver doesn't just rally, it gaps. You won't be able to buy it. The premiums on physical coins and bars will detach from the spot price instantly. You might see spot at 90, but the dealer will quote you 120. That is the moment the paper market becomes irrelevant. If you are holding paper silver, ETFs, unallocated accounts, futures, you're holding a promise that cannot be kept. You're holding a claim on a metal that has already been rehypothecated 5 times over. That is the scenario where the squeeze becomes a default. Now, look at the other side, the deflationary grind. This is the risk that keeps me up at night. This is a scenario where the Fed keeps rates high, the economy slows, but nothing big breaks immediately. We just bleed. The dollar gets stronger because it's the cleanest shirt in the dirty laundry. Capital flows out of emerging markets and back into US Treasuries. In this world, silver faces a massive headwind. The industrial demand, solar, electronics, EVs, slows down because the global economy is contracting. The speculative money leaves. The price could drift back down to the 70s, maybe even lower. It would be slow, grinding, painful correction that shakes out everyone who bought the hype. But here's the catch. Even in that deflationary scenario, the physical shortage doesn't go away. The mines are still depleting. The grades are still falling. The cost to pull an ounce of silver out of the ground is still rising because energy costs are sticky. So even if the price drops, the floor is structurally higher than it was in 2020 or 2022. You might lose on paper, but if you hold the metal, you're holding an asset that cannot be printed and cannot be bankrupted. So knowing these two paths, what is the playbook? What am I actually doing with my capital right now? Number one, I'm watching the silver lease rates. This is the most honest signal in the market. It's the cost to borrow physical silver in London. When lease rates spike, when it becomes expensive to borrow the metal, it means there's a shortage of deliverable bars. Right now, those rates are elevated. They're flashing yellow. If they turn red, if they go vertical, it means the vault is empty. It means the shorts are trapped and the price is about to explode regardless of what the dollar does. I check this every morning before I check the price. Number two, I'm watching the SLV versus PSLV flows. This is technical, but it matters. SLV is the big ETF that relies on authorized participants and unallocated votes. PSLV is the trust that actually sources physical metal and takes it off the market. When I see money flowing out of SLV and into PSLV or into physical delivery, that tells me the smart money is de-risking. They're moving from exposure to ownership. That trend has been accelerating for 3 weeks. It tells me the confidence in the paper system is eroding. Number three, I am not using leverage. I cannot stress this enough. If you are trading silver with 10-to-1 leverage right now because you think the breakout is here, you are going to get carried out on a stretcher. The volatility we saw on Tuesday, that 12% swing, that is designed to kill leverage. It hunts stops. It wipes out accounts. I am holding spot positions. I am holding physical. I am holding fully paid for mining stocks. I am not borrowing money to bet on a rigged casino. The time for leverage was at $60. At 86, with the VIX rising, leverage is suicide. And finally, I am watching the reverse repo facility. This is the plumbing of the dollar system. If the cash in the reverse repo drains to zero, and we are getting close, the liquidity buffer is gone. That's when the volatility really starts. That's when the Fed loses control of the short end of the curve. When that buffer hits zero, the next treasury auction that fails sends a shockwave through the entire system. And silver? Silver loves a failed auction. It loves the moment the government realizes nobody wants its debt. I want to be clear about what would change my stance. I am not a zealot. If I see the miners start aggressively hedging their production, if I see them selling forward 5 years of supply at these prices, I will sell. I will respect their knowledge of their own business. If the guys digging it out of the ground think 86 is a great price to sell at, who am I to argue? But they aren't selling. They're hoarding. They're holding back inventory. They're doing exactly what I'm doing, waiting for the real price discovery. We are in a window of extreme dislocation. The refusal to break on Tuesday was a signal, not a guarantee. It told us that the buyers are stronger than the sellers right now. It told us that the fear of missing the boat is greater than the fear of the Fed. But markets are cruel. They will test that resolve again. We will likely see another flush. We will see another attempt to break the price down. The question is not, will it happen? The question is, will it hold? If silver holds 80 again, if it treats that level as concrete support, then the structure has changed. Then we are no longer in a cyclical bull market. We are in a secular repricing. We are moving toward a world where the price of silver is determined by the physical scarcity, not the paper leverage. And that is a world most investors are completely unprepared for.